Hi there, welcome to Kneppy Invest. Let's talk Sonic. And I don't mean Sonic the Hedgehog, or for those who do or have heard about it, Sonic the fast food chain in the United States. No, I am talking about Sonic Healthcare, a company listed on the ASX for about 30 years, if I remember correctly. I think about 1990, 1991, a company that has grown quite considerably. In fact, when this company listed on the ASX, I think the share price was like 4 cents, something ridiculous like that. Now it's almost $40. So this is a sort of company you would have loved to have bought back when it listed and have maintained a holding ever since then. Not only that, dividends have increased continuously over the last 20 to 30 years. So let's have a look at Sonic Healthcare and whether this is worthy of belonging in your portfolio. For full disclosure purposes, I actually am a Sonic Healthcare shareholder. And I'm not a Sonic Healthcare shareholder because I classify this company as high quality. And when I took a position, I saw some value there. The main reason I took a position in this company was just a technical signal. However, in saying that, I probably would listen to arguments of those who want to classify this company as high quality. And I'll talk about that later in the video. The first thing that comes to my mind when I hear the name Sonic Healthcare is pathology. And the vast majority of this company's revenue is through their pathology division. But this company is a little bit more than pathology. They also have a radiology division and also a medical center and occupational health. But again, the vast majority of their revenue is through pathology. And we'll have a look at the breakdown of their revenue later in the video. Not only breakdown of the revenue by division, but also breakdown of the revenue by country. Because not only is Sonic Healthcare the market leader in pathology in Australia, they're also the market leader in Germany, Switzerland, UK, Northern Belgium, and the third largest private laboratory company in the United States. And also their radiology division is the second largest radiology provider in Australia, with over 120 radiology centers in this country alone. So even though I think of Sonic Healthcare as pathology, they're a little bit more diversified than that. So Sonic Healthcare is a global country, not a complete global country because they don't operate in every single country in the world, but they do have operations in Australia, New Zealand, United States, United Kingdom, Belgium, Germany, and Switzerland. And in this particular slide, you can see where they entered the year they entered each of these markets. For an instance, in Australia, 1987, New Zealand, 1999. Then they went into United Kingdom, 2002, Germany, 2004, United States, 2005. So they're quickly expanding throughout the world during these years. Switzerland, 2007, and then it seems like the GFC sort of stalled their expansion plans because after the GFC, they've only gone into one other country, and that is Belgium in 2010. So they haven't expanded anywhere else over the last 13 years. And this could be a little bit of a red flag. Potentially they have stopped their expansion plans, or maybe in the future they will try to expand elsewhere in the world. I just don't know. And at this point in time, they are being successful with what they're doing, but at some point in time, they will become mature in each of these markets, and hopefully they will continue to expand around the world. The current CEO of Sonic Healthcare is Dr. Colin Goldschmidt, and not only is he the current CEO of this company, I was going to say company, he's been the CEO since January 1993. He's just celebrated his 30th anniversary as being the CEO of this company. So if you want to discuss stable management, Sonic Healthcare is that sort of company. Now, I can think of advantages, pros, and cons of having a CEO in the role for 30 years. Potentially has become more conservative over that 30-year period, and maybe that's why this company is not expanding anywhere else, because generally people do become a little bit more conservative as they do get older. Now, I have no idea how long he wants to stay in this role, because I'd say since he's been the CEO for about 30 years. He's probably at least in his 60s, maybe in his 70s. So at some point in time, there needs to be some sort of transition plan or succession plan. I'm not talking about the TV show, but there needs to be some sort of transition succession in changing CEOs. And it's going to be really interesting to see how the market reacts to that news, because when a CEO has been in a role for 30 years, when there is going to be change, that could be a bit of a shock to the system. Now let's talk quality, and this is a topic where I think a lot of debate would be very useful, because I don't think you could go wrong calling Sonic Healthcare a high quality company, and probably couldn't be wrong either by questioning whether it is a high quality company for differing reasons. I can definitely see an argument each way. So this is my breakdown when I started to look at the quality of this company. So the first thing I always look at is revenue growth. And this is revenue per share growth, which is very important to distinguish from just revenue growth. Now, for a company like Sonic Healthcare, shares on issue haven't probably been increasing all that much over the past 10 years. But their revenue per share growth is around 10. So over the last 10 years, 8.5%, 5 years, 10.3%, 3 years, 12.7%. But that growth in revenue per share over the last 3 years has been helped by COVID-19. And they are feeling sort of headwinds right now, because those positive tailwinds of COVID-19 are coming to an end. Now, return on invested capital, I tend to want to see that above 10. And the 10-year median is 6.8. And right now, their return on invested capital is right on 10 or just below 10. EV to EBIT, 12.4. We'll have a look at the valuation metrics later in the video. Probably would prefer that to be around 10 as well. And then you look at the total return of this company over the past 10 years. So this is share price appreciation plus dividends. And 12.9% compound growth of this company in total returns is the sort of returns that's quite nice. Not quite what I'm looking for, but definitely Sonic Healthcare would be a nice, or would have a nice position in your portfolio if it is returning or giving you a 12.9% per year. And my thoughts on this company was, in terms of quality, was highish. Not quite willing to call this company high, or the quality of this company high, just because I would prefer to see a little bit higher growth, revenue per share growth, and a little bit higher return on invested capital. So I mentioned here in the notes, revenue growth around 10, return on invested capital typically between 5 and 10. And that is my main red flag when it comes to this company. And I also mentioned okay value, but we'll have a look at the value later in the video. Now let's have a look at the financials for Sonic Healthcare. And this is the trailing 12 months, which means it's the first half of financial year 23 plus the second half of financial year 22. At a share price of $36.26, Sonic Healthcare has a market cap of $17 billion, which makes it one of the largest companies on the ASX, or within the top 50 at least, but definitely this is a large cap company on the ASX. Revenue of $8.65 billion, profitable by just over $1 billion, operating cash flow positive by $1.97 billion, and free cash flow of $1.55 billion. So I do like that operating cash flow and free cash flow. Those are nice numbers, particularly when you look at the market cap of $17 billion. Now on to return on equity and return on invested capital. Now, the reason I've included both of these is because of a lot of investors, a lot of professionals, a lot of fund managers prefer to look at return on equity, and sort of the lower end of what they're looking for is about 10. So when they see a company with a return on equity above 10, that would be a green flag. For Sonic Healthcare, that is 13.7. Now, I prefer return on invested capital because that includes debt. In my opinion, it's a little bit more conservative than a return on equity. And for Sonic Healthcare, that is right on sort of the low side of what I'm looking for in a high quality company at 9.8. I would prefer that to be above 10. But as I mentioned in the previous slide, typically Sonic Healthcare has a return on invested capital between 5 and 10. I would prefer that to be typically between 10 and 15. Now let's have a look at the half year results for financial year 23. And if you just looked at these numbers in isolation, you might be horrified because a lot of negative numbers, and when I say negative numbers, I mean negative changes in revenue, EBITDA, net profit from the first half of financial year 22. For instance, net profit down 54%, EBITDA down 40%, cash generated from operations down 25%, and total revenue down 14%. But the main reason behind that decreases in all these numbers is because of COVID-19. And in fact, they're breaking down revenue into base business revenue and COVID-19 revenue. And base business revenue actually rose 9%, while COVID-19 revenue dropped 72%. So I probably would expect COVID-19 revenue to drop even further in this half year. And then in the next year or maybe 2 years, you won't see any mention of COVID-19 revenue at all in Sonic Healthcare. And in this particular slide, you can just see the benefits of COVID-19 for this company, particularly in first half of financial year 21 and the first half of financial year 22. This company generated $1.2 billion of revenue in 2021 and $1.3 billion of revenue in 2022 because of COVID-19, and that has dropped off significantly in this half year. And the base business revenue, even though it was sort of going sideways from 2020 to 2022, we have started to see that increase. And I would expect, say, a 10% increase in revenue, at least a 10% increase in revenue in their base business moving forward from here over the next few years. One of the things I like to look at when a company releases the half year or 4 year results is a breakdown of the company's revenue by division or sector, or whatever they want to call it, and by geographical location. So sometimes they'll call it disaggregated revenue, and you can usually find this either in the notes or if the company releases a presentation, typically they will have some breakdown of their revenue in the presentation. In fact, they should have a breakdown. Anyway, so on the left-hand side, we have a nice pie chart breaking down their revenue by geographical location in terms of pathology and also the different divisions. So, for instance, radiology, $388 million of revenue generated in this half year, which was 10% of the company's revenue. The other division, which is medical centers, occupational health services, only generated 5% of the company's overall revenue. And the rest of the revenue was their pathology division. And then it's broken down by country. So 26% of this company's revenue comes from the United States, 24% comes from Australia, 19% Germany, 7% Switzerland, 7% UK, 2% Belgium, and New Zealand, unfortunately, does not have a percentage because they only generated $15.2 million of revenue. The first step I take in deciding whether a company is high quality or not is revenue per share growth. Now, this is not revenue per share growth. This is just total revenue growth for Sonic Healthcare over the past 10 years. And this company has seen their revenue grow from 3.5 billion up to 9.3 billion. So not quite tripled, but this is the sort of revenue growth you want to see for a company. It's nice and steady. In fact, there was not one single year here where revenue actually dropped. Maybe financial year 23 will be the first year where this company experiences revenue dropping. That's not a bad sign moving forward because a lot of companies over their lifespan will see, even in the growth phase, we'll see a period of time where the revenue might drop. The other thing I've included on this particular slide is the operating margins. Now, before COVID-19, Sonic Healthcare had operating margins between about 12 and 13%. It was fairly steady. And then all of a sudden, probably because of COVID-19, the operating margins rose to about 23%. So moving forward, this would be my concern. Even if this company does experience some good revenue growth in the next few years, that operating margins will fall back to about 12 or 13%, which would put a bit of stress on the company's profits. Another way you could determine whether a company is high quality or not is just by looking at a dividend history. And this is Sonic Healthcare's dividend history since 1994. Maybe that was the first year this company provided their shareholders with a dividend. And the main thing you take away from this particular slide is that dividends have been growing ever since that year. There was only a few years here where dividends were flat, between 2010 and 2012, just after the GFC. But generally, dividends for this company have been growing through time. Now, there is a possibility that this year, financial year 23, will be the first year where dividends have dropped for this company, and the dividend yield is a nice 2.8%. Now, into some valuation metrics. So, if you thought Sonic Healthcare was a high quality company, and there's no question about that, I probably would be looking at whether the share price at $36 or such represents good value. So let's have a look at some valuation metrics. P ratio, right about 17. Now, I probably would think that more than likely earnings for financial year 23 would drop from last year, which would mean the P ratio of 17, even though it's on the lower side, that could be a little bit deceiving. Price to sales ratio, 1.99, price to operating cash flow, 8.7. That is a sort of number I am looking for in this type of company, a pretty good price to operating cash flow, less than 10. And I also did a reverse DCF based off the earnings per share. And again, I would expect earnings per share actually to drop. I think that's probably a good chance in financial year 23. But this is looking over the next 10 years. So Sonic Healthcare would have to grow their earnings per share at 9.8% over the next 10 years per year to justify the current valuation. And I definitely think this company can achieve that sort of growth rate. I think that sort of growth rate is probably just around or just below what they might achieve. So I'd probably call the valuation right now of Sonic Healthcare fair value. I wouldn't say it's overvalued, wouldn't say it's undervalued. One thing I always like to do is just look at the P ratio or some sort of valuation metric ratio, valuation metric, whatever. So it could be price to operating cash flow, EV to EBIT, whatever you want, or whatever valuation metric you want to look at. And I just like to look at that valuation metric where it is now compared to history. So for Sonic Healthcare, before the COVID-19 financial panic, the P ratio for this company was consistently above 17.5. In fact, it went above 17.5 back in 2013 and remained above that even during COVID-19 all the way through to 2021. So straight away, that would be telling me anytime you see the P ratio of this company falling below 17.5 could be representing good value. But in saying that, the P ratio of this company has been below 17.5 since 2021. I think main reason behind that is because this company saw an explosion in their earnings because of COVID-19. So the earnings are a little bit exaggerated to the high side. And that's why the P ratio went as low as 10 in the past year. So I wouldn't quite say that a P ratio of about 17, which is right now, represents good value just because of those tailwinds generated by COVID-19 and the very fact the company has moved into some more headwinds because those COVID-19 tailwinds are coming to an end. And you sort of can see the changes of the winds just by looking at a chart for Sonic Healthcare. This is the daily chart going back to December 2021. The reason I want to go back that far is because in like the first trading day of 2022, remember that was sort of the high point in the market. That was also the high point in Sonic Healthcare share price. It got to a high of $47 on either the first trading day of 2022 or the last few trading days of 2021. And then the share price just fell off quite quickly in the first few months of 2022 and then went into sort of I wouldn't say a long-term downtrend, but definitely a medium-term downtrend. Share price went from that 47 down to a low of 28. So the share price didn't quite halve, but it did fall quite a bit percentage-wise. And then in February, right around the time the company, or right on the time the company released their half-year results, the market shifted its sentiment in regards to this company in one day. So that positive sentiment shift, or that sentiment shift, was because of the half-year results, maybe even some commentary in the half-year results that the market liked it. And not only did that shift the sentiment, it also shifted the trend in the company's share price from negative to a positive trend. In fact, the share price has moved higher ever since the release of the half-year results. We saw a little bit of a dip in the next about 6 or 7 trading days after they released the half-year results, and that was the time to buy. Share price fell just below $32, but we have seen a share price go from about $32 up to current share price of around about $36.50. And I probably should have mentioned that that's why I took a position in this company. It was just that shift in sentiment, shift in the trend in the share price. But if you look at the long-term chart for Sonic Healthcare, and this is the monthly chart going all the way back to when they listed on the ASX in 1991. This is the sort of chart you want to see if you were or are a shareholder of this company since they IPO'd, because way back then, you can barely see what the share price was because it was so low, it doesn't quite fit on this chart. I think the share price was something like 4 cents. It was quite low, maybe not that low, but it was quite low. But the share price of Sonic Healthcare has been in a monthly uptrend ever since then. And this is another argument in calling this company high quality, because you have the share price moving up through time. Now, on occasion, the share price does go through a short to medium term downtrend like we did see during 2022. But if ever the share price got to around the 150-month moving average, which is the blue line, that seems to be a really nice support level, or if the share price did fall sort of in between the 75-month and the 150-month, which is sort of the bottom of that green zone and the blue line, that's another good support level. And we did see the share price try to get into that zone during the COVID-19 financial panic. And also, it hit the bottom of that green zone right on $28 when it hit that low just before the company released the half-year results. So that was the time to buy, because you had the long-term monthly uptrend support, and also because the share price broke out, we had a change in or shift in sentiment and a change in the trend in the share price. And so everything looks pretty good when you look at the long-term chart for Sonic Healthcare. The next 5 companies I plan on doing a video in this series include or are Iris, Parenti, Santos, Clover Corporation, and the next video I will release will be on advanced braking technology. If you do have any suggestions for a company you'd love me to feature in this series, you can leave that suggestion or that recommendation in the comment section of this video. I do prefer doing videos on companies that are profitable, growing, or don't have to be really growing, but definitely profitable. They can be small cap, micro cap, large cap, mid cap, but definitely companies that have some sort of product they are selling and are profitable. That's all I have for this look at Sonic Healthcare. If you have any questions about this company or maybe any other company on the ASX, including Australian Clinical Labs and Highish, which are 2 competitors of this company. In fact, I currently own Sonic Healthcare and I was a shareholder of Australian Clinical Labs. I have never held Highish. Pretty sure that's the other pathology company on the ASX. I'd love to hear any thoughts you have on those 3 companies. So leave your thoughts in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.